During the last four U.S. presidential election years, 2008, 2012, 2016, and 2020, the stock market, as represented by the S&P 500, showed varying degrees of performance across the months of October, November, and December. The market's movement during this period was often influenced by election outcomes, policy expectations, and broader economic conditions. In 2020, the market initially dipped in October due to election uncertainty and pandemic concerns. However, it rebounded strongly in November, with a gain of 10.8% after Joe Biden's victory and optimism over COVID-19 vaccines, closing the quarter with a gain of 10.8%. In 2016, the market reacted positively to Donald Trump's win, with a solid rally in November, gaining 3.4%, driven by expectations of tax cuts and deregulation. The quarter ended with a gain of 3.3%. In 2012, during Barack Obama's re-election, the market remained relatively flat. After modest gains in October, with 0.5%, it experienced slight losses in November and December, resulting in a small fourth-quarter decline of 1%. Election years often bring volatility and uncertainty to the stock market, with October frequently seeing a dip. However, November tends to reflect market sentiment regarding the election outcome, and December can provide further stabilization. In recent years, the market has generally reacted positively to the clarity brought by the election results, particularly when new policy directions are expected. While individual months may be volatile, the overall performance in the fourth quarter during election years has generally been positive, except when external economic pressures like the 2008 financial crisis have weighed heavily on market performance. The U.S. stock market is often a focal point during election years, as investors anticipate how political shifts might impact economic policies, corporate profitability, and overall market stability. Historically, market performance during election cycles follows recognizable trends, influenced by uncertainty, policy expectations, and economic outlooks. Here's a breakdown of how U.S. markets typically behave during election periods. Leading up to elections, markets usually experience increased volatility. Investors become cautious as they await clarity on potential policy changes that could affect industries such as healthcare, energy, and finance. Markets react to shifts in polling data. A candidate perceived as more market-friendly, often viewed as having pro-business policies, can boost investor confidence. While uncertainty or a perceived threat to business interests might cause market dips. Historically, when an incumbent president is reelected, markets tend to react positively. Investors value stability and are familiar with the incumbent's policies. The belief that the devil you know is better than the devil you don't often leads to reduced uncertainty, which can translate into market gains. While there is ongoing debate about whether a Democratic or Republican president is better for markets, studies show mixed results. The stock market has generally performed well under both parties over the long term. Though market reactions may vary based on perceived business friendliness, tax policies, and regulatory stances. Once election uncertainty clears, markets often experience a relief rally, especially if the results are decisive and align with investor expectations. Regardless of which party wins, the certainty of the outcome often encourages renewed investor confidence. If the election results lead to a change in administration, the market typically adjusts during the transition period. This adjustment happens as the market reacts to the new president's cabinet appointments, first 100-day policy goals, and congressional alignment. Markets tend to prefer a divided government, where one party controls the presidency while the other controls one or both houses of Congress. The idea is that a divided government can result in gridlock, preventing major policy shifts that could destabilize markets. On the other hand, a unified government allows the ruling party to push through more aggressive policy changes. These changes can either be positive or negative, depending on the specific policies enacted. The stock market has historically followed a pattern during the four-year presidential cycle. The second year of a president's term typically sees weaker market performance due to midterm elections and policy uncertainty. In contrast, the third and fourth years, the latter being the election year, tend to show stronger market performance. This is as political clarity emerges and candidates propose pro-growth measures to appeal to voters. Since 1928, election years have averaged positive returns for the stock market. For instance, the S&P 500 has typically gained about 7% in election years. Though results vary depending on economic conditions and geopolitical events. Sectors such as healthcare, defense, renewable energy, and finance are especially sensitive to election outcomes. For instance, a Republican victory might boost defense stocks due to expectations of higher military spending, while a Democratic win could benefit renewable energy companies due to promises of green energy investments. Election years can introduce volatility and uncertainty into the market, but they also present opportunities. Historically, U.S. stock markets have shown resilience and often end up performing positively in the months following an election. While it's impossible to predict specific outcomes, understanding the market's typical reactions to election cycles can help investors navigate the uncertainty. Let's explore the historical performance of U.S. stock market sectors during election years. In 2020, after Joe Biden's election, consumer discretionary rose 25.5%, healthcare increased 10.5%, and financials gained 16.6%, while energy declined 10.3%. Technology surged 43.9%, and materials gained 23.4%. In 2016, Donald Trump's victory led to a 12.5% increase in consumer discretionary and a 22.9% surge in financials, while the energy sector rose 27.4%. Healthcare gained just 1.5%, and technology saw a 9.8% increase. During Obama's re-election in 2012, consumer discretionary rose 5.2%, and healthcare gained 13.5%, with financials increasing 24%. Energy saw modest gains, while technology rose 14%. In 2008, the election was overshadowed by the financial crisis, leading consumer discretionary to drop 15.6%, while healthcare gained 4.8%. Financials experienced a sharp decline of 39%, and technology dropped 42.9%. In 2004, after Bush's re-election, consumer discretionary rose 4%, healthcare gained 10.5%, and financials increased 13.5%. Energy also performed well, gaining 13.1%. In 2000, Bush's election coincided with a tech boom, where technology surged 28.3% despite consumer discretionary falling 11.3%. This historical performance shows how political outcomes can significantly influence market dynamics. This is for educational purposes only. Do your own research before making any bets on stocks or sectors, and check out some of our other videos linked in the description for trading and investment strategies.